The global narrative is dominated by two competing priorities: the urgent existential necessity of mitigating climate change and the unrelenting geopolitical imperative of maintaining economic dominance. These two forces, climate salvation and financial hegemony, are moving on a collision course. The financial system of the modern world is built on one foundational concept: the US dollar is the anchor. This supremacy is often attributed to the depth of US capital markets and military strength. But its silent, fundamental pillar is the petrodollar system. This system forces the world to hold dollars because it must buy oil in dollars. What happens when the world no longer needs the oil that powers the system? This documentary provides a rigorous, data-driven analysis of the green energy trap. This trap is a dangerous paradox, wherein the successful global shift toward renewable energy, while crucial for ecological survival, inherently dismantles the petrodollar system, the silent anchor of US economic hegemony. Success in climate policy translates directly into the structural erosion of dollar dominance, creating a profound, non-kinetic threat to the current financial order. We will expose the deep structural forces that determine the dollar's fate, analyze the aggressive geopolitical accelerants now in play, and reveal how the strategic focus of global power is shifting fundamentally from the flow of oil to the stock of critical minerals. If you believe the dollar's supremacy is permanent, you are already preparing to be blindsided. History shows that every empire that fails to adapt to new resource realities is crushed by them. The petrodollar system is the most significant financial arrangement of the post-gold standard era. It did not emerge from a desire for stability, but from a necessity for survival following the collapse of the Bretton Woods system. In 1971, President Richard Nixon unilaterally terminated the gold standard, cutting the dollar loose from metallic backing. The dollar was on life support, facing surging inflation and broken confidence. To secure the dollar's continued necessity, Washington made a secret pact with Saudi Arabia in the 1970s. The core agreement was simple: every barrel of oil sold worldwide would be priced exclusively in US dollars. In return, the US guaranteed the kingdom's military security. This pact birthed the petrodollar system, replacing the gold standard with an energy standard. This forced every nation on Earth to hold and trade dollars, because no nation could run its economy without oil. This new imperial system was enforced not by armies, but by markets. The most critical component of this architecture is petrodollar recycling. Oil-producing nations, receiving vast amounts of USD for their exports, generate massive trading surpluses. To keep these revenues safe and liquid while earning a return, these nations transfer the funds into dollar-denominated assets, principally US Treasury securities. This institutionalized flow of capital back into US financial markets is genius. It reinforces the dollar's status as the dominant reserve currency, essentially funding US deficits and allowing America to run deficits that would sink any other empire. This is the essence of the exorbitant privilege granted by the dollar's reserve status. The petrodollar system relies less on an explicit contract and more on established global market behavior, inertia, and the institutional convenience it affords. However, the market reacted fervently to debunked rumors in mid-2024 suggesting the non-renewal of a 50-year deal, highlighting that market psychology is already sensitive to de-dollarization narratives. This sensitivity is a factor that could accelerate future shifts away from the dollar even without concrete policy changes. The threat is not external military rivalry, it is structural demand destruction. The green energy trap posits that the necessary global policy drive toward decarbonization directly and structurally diminishes the economic requirement for US dollars. The petrodollar's strength is anchored in the continuous, massive global demand for oil. The shift toward widespread adoption of electric vehicles, EVs, renewable electricity generation, and clean fuels, success in climate policy, translates directly into the erosion of the petrodollar system. Every solar panel installed, every EV sold, quietly reduces the demand for dollars. This mechanism reduces the volume of global transactions requiring USD settlement. If oil is no longer the primary energy source, America loses one of its key levers of global influence. The severity of the petrodollar risk can be quantified by examining divergence between climate policy scenarios. The status quo trap, STEPS. Under the stated policy scenario, STEPS, which relies only on existing government policies, oil demand is predicted to peak before 2030, but still reaches 113 million barrels per day, MBD, by mid-century. This outcome would keep the petrodollar system substantially intact, but risk catastrophic global warming, potentially leading to a temperature rise of 2.7 C by 2100. The collapse scenario, NZE. In contrast, the net zero emissions by 2050 NZE scenario, which aligns with the 1.5 C climate goal, projects a dramatic collapse in oil demand to just 24 barrels per day by 2050. Achieving this requires oil and gas demand to fall by more than 5% annually. This radical reduction would functionally dismantle the petrodollar's structural demand anchor. The tension between these two outcomes confirms that the quantification of peak oil demand has become a critical geopolitical leverage point, directly influencing confidence in currency stability. Some high-income economies, including the U.S., have recently weakened low-carbon support, a policy incoherence that risks alienating global partners and delaying the establishment of the new energy economy. While the use of oil for transportation declines, oil AS' role as a feedstock for plastics and petrochemicals will provide a structural floor for residual demand. Refining operations are expected to pivot to focus more heavily on petrochemical feedstocks. However, near-term market dynamics are already stressing oil producers. Global oil production, particularly from non-OPEC countries like the US, Brazil, and Guyana, has surged to record highs, overwhelming the market and depressing prices. These lower prices challenge oil exporting nations that rely on high revenues to fund vast domestic budgets. This financial pressure ironically acts as a compounding factor, potentially accelerating the search by oil producers for non-dollar payment methods to circumvent dependency on an unstable, price-depressed market. The structural threat posed by the energy transition is being aggressively hastened by deliberate geopolitical de-dollarization efforts. These two forces, structural decline and political action, are converging to attack the dollar's dominance. A major catalyst for de-dollarization is the continuous weaponization of the dollar by the US and its Western allies. The deployment of extensive economic sanctions and restrictions on access to the global SWIFT financial messaging system has forced many nations to prioritize financial sovereignty and independence from American coercion. This is the modern equivalent of seizing gold trains during a revolution. The international campaign of sanctions against Russia following the 2022 invasion of Ukraine represents the largest use of financial pressure ever deployed. While they initially shocked the Russian economy, they accelerated a fundamental and likely permanent split in global financial systems, driving emerging economies rapidly toward alternatives, particularly the Chinese yuan or RMB. The situation creates a critical nexus of risk. Geopolitical fragmentation provides the motive for de-dollarization, driven by sovereignty concerns and the realization that their reserves can be frozen with a stroke of a pen. Simultaneously, the energy transition provides the structural economic opportunity by reducing the fundamental global need for USD reserves. This mutual reinforcement ensures the progression toward a multipolar currency system is kinetic and policy-driven. While the Chinese renminbi, RMB, is frequently championed as the petrodollar's successor, petroyuan, the current institutional infrastructure shields the USD from immediate collapse. The RMB faces significant operational hurdles. It lacks the deep liquidity and full convertibility that the USD offers. Furthermore, alternative recycling mechanisms are limited. There is a lack of acceptable fixed income assets, usable government securities, for central banks to park their massive surpluses. The US holds a key advantage in trust, market depth, and institutional convenience. However, the dollar's superior institutional infrastructure shields it from immediate collapse, but a strategic and enduring shift toward a multipolar currency system is underway. As the world transitions from an energy system based on oil to one based on electrons, the geopolitical locus of control shifts dramatically. The financial power derived from controlling the flow of oil is moving toward the control of the strategic stock of critical minerals. Critical minerals, lithium, copper, rare earths, and cobalt, are essential for renewable infrastructure, battery technology, and electric vehicles. Geopolitical power will increasingly be derived from controlling the supply chains of these materials. This emerging geopolitical challenge is the rise of a commodities alliance, primarily centered around the BRICS nations and China, which already holds a dominant position in mineral processing, refining, and strategic stockpiling. China's existing control over the midstream of the critical mineral supply chain positions it to potentially exert a level of influence over the new energy system that rivals or exceeds OPEC's previous oil dominance. This establishes a new geopolitical fault line. To navigate the green energy trap, the U.S. must pivot its geo-economic focus from securing hydrocarbon supply to dominating the critical material supply chain. The long-term security of the United States depends on becoming the undisputed leader of the green economy, replacing the petrodollar's anchor with a new, stronger industrial foundation. This involves diversifying supply, developing alternative materials, and establishing robust recycling capabilities. If the U.S. fails to secure the new energy anchor, its financial dominance will suffer a catastrophic long-term erosion. The danger to the dollar lies in the timing of this transition. The structural erosion of the petrodollar is a gradual force dictated by the slow transition away from fossil fuels. However, geopolitical events, sanctions, fiscal instability are immediate episodic shocks. The primary risk is the synchronization of deep structural decline, oil demand falling sharply, with a major political or financial catalyst, such as a credit rating downgrade or a sudden fiscal crisis triggered by rising debt concerns. The U.S. is uniquely vulnerable to this internal catalyst due to its massive fiscal addiction. America sits atop more than $34 trillion of debt, and interest payments alone are now larger than the defense budget. If confidence cracks due to this unsustainable fiscal trajectory, the consequences would shake the entire global system. Mexico's peso crash in 1994, which required a $50 billion bailout, serves as a warning that history shows no empire is too big to fail. The U.S. is risking its own financial credibility, which is the ultimate defense of the dollar against both structural decline and geopolitical attack. As the financial system becomes multipolar, increased currency volatility is inevitable. The erosion of the petrodollar and the consequent decline in dollar demand could lead to several global costs. The world pays more to finance itself due to higher global borrowing costs. Hot money flows destabilize emerging market economies, EMEs. Fragmentation increases transaction costs due to the breakdown of unified payment and trade invoicing systems. This is the chaotic, messy, and unequal transition that accompanies the end of any monetary order. The green energy trap reveals the ultimate power dynamic. The United States cannot afford to lose the vital leverage and reduced borrowing costs associated with its reserve currency status. Therefore, strategic policy must pivot from supporting the old energy order to dominating the new one. The dollar, like every reserve currency before it, from Rome's denarius to Britain's pound, is subject to the same relentless pattern of abuse and eventual decline. The modern system, built on debt and fiat, relies entirely on the illusion of stability. Money as propaganda. Leaders use money the same way Roman emperors did, as propaganda for stability. But every illusion eventually meets its limit. The power of control. As trust breaks, control fills the gap. Central banks are racing to design the next system, visible in the research. The green energy trap is forcing a systemic change. But the architects of the system will seek to maintain control, transitioning power from the flow of oil to the flow of electrons, and ultimately to the code of programmable money. In this environment of structural uncertainty, financial education is self-defense. History. S verdict never changes. Wealth is built and preserved by recognizing patterns and acting outside the traps. Real wealth. When money dies, paper promises vanish. Survival hinges on possessing real assets that cannot be printed away. Skills that produce value, land that grows food and gold, or commodities that people actually value when currency doesn't. Skepticism. You must cultivate deep skepticism toward official stability narratives. You must look beyond the headlines and ask who profits when money loses its meaning. Mindset. Financial freedom is achieved by mastering your desires, not by filling your purse. It is about resilience and building clarity in a system designed for confusion. The green energy trap is not merely a hypothetical economic scenario. It is an active geopolitical reality. The US dollar AS dominance faces a dual threat: structural decline from energy transition and political acceleration from de-dollarization. The ultimate defense against the green energy trap is not hoping the system survives, but knowing what survives the collapse. History does not repeat, but if you do not understand the blueprint of decline, it will crush you all the same.